Better System Trader, Episode 18.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 18 and I'm your host, Andrew Swanscott. This week's guest is the leading expert on trading the opening gap, launching masterthegap.com in 2008 and publishing over 1,500 daily gap analysis videos and his exact gap trading plan prior to the market opening each morning. He's highly respected for his comprehensive analysis and is known around the world as the Gap Guy. His quantitative research and analysis has been published in most industry-leading journals and sites, and he has also been a popular speaker at many trading expos, meetups, and investing groups. In this week's episode, he shares his expertise in trading gaps, explaining what factors to take into account when trading gaps and what to avoid. We also discuss gap zones, when to fade and when to follow, and calculating stops and targets. Now, even if you're not into trading gaps, we cover some really important concepts that can impact all styles of trading, including one concept called Ensemble systems, which may just change the way you look at trading strategies. Anyway, let's get to it. Today's guest is Scott Andrews, the Gap Guy. Hope you enjoy it. Hi, Scott. Thanks for joining us today. A lot of people will recognize your name from your Master the Gap and the Gap Guy websites, but for those unfamiliar, can you please give us a little bit of background on yourself and how you got started in trading?
Sure. Thank you for having me, Andrew. I was fortunate to start a .com back in the 90s that was actually successful in raising venture capital and ultimately getting public. And it was a pretty crazy, wild experience. We were a technology, web-based application helping corporations, pharmaceuticals, biotechnology companies, universities streamline the procurement with what is now is known as software as a service business model. So they would utilize our software. And it was a wild ride. We were very fortunate, caught the timing just right, and I got the company public with lots of funding, and I got a front row seat to how Wall Street really worked and works, because I was always interacting with analysts and institutional buyers that were looking to invest and buy in our stock, and it was fascinating to see the analysts value our company. And I'll admit I benefited from their overvaluations, but back in the .com days, it was pretty scary stuff. I think we had $5 million in revenues when we went public, and one time we had a $2 billion market cap. So I'll admit it actually deterred me from my trust and interest in being a long-term investor in the market, because I didn't know that I could ever trust analysts again. And not all analysts were bad by any means, but there were a few unsavory characters who really had no interest in what the truth was about our story. And we thought we had a great story. And I'm actually very happy to say the company survived and still trades on the NASDAQ. So we were a real company and grew up into a real company, but there were crazy times. And during that time, while I watched our stock price go way up and then ultimately way down in the crash of 2001 and 2002, I did become completely and utterly fascinated with watching stock prices, not only my own, but some of our competitors and so on. And I think that really sealed my interest. So we took the company private. We've since taken it back public again. But when we took it private, I stayed on for a year or two and made sure the company made the transition. But I had a little bit of time and money. I stepped down as CEO to really do what I wanted to do when I grew up. And actually, my wife has suggested that why don't I try trading? Because I was actually having some success just dabbling in the markets as I was evaluating other opportunities. And instantly, I'm like, wow, I hadn't thought of that. And I did have time and money to dig in and see if I can make a go of it. So not to belabor the story, but I hooked up with, or should say found a guru, we'll call him that, and he was a real options guru. He really was. He was legit. He made a lot of money in the markets, but he overrepresented, maybe is the best way to say, his ability to provide rules on how the markets work. And he would always say, just trust me, follow my rules. And all of his rules, by the way, were completely indicator based. So he had his magic secret sauce of indicators that he shared with us. And when they all lined up, you had to buy. And when they didn't, you wouldn't. And you'd sell when they turned back over. It worked great in the bull market of 2003. And I was pretty convinced I was God's gift to the trading world. Told my wife that was the case. I had found my calling. This is what I was meant to do, just make money, print money from the stock market, because I was smarter than everyone else. And then the market, if you go back and look at your charts, the market's turned sideways. It wasn't even really a down market in 2004. We just went sideways, basically. And the strategy completely fell apart. So everything he had told me that was supposedly this market neutral strategy just wasn't true. And I gave back everything I made. I actually made six figures on a small six-figure account. I was conservative, and I just was convinced I knew what I was doing. But in reality, I really didn't. And I gave it all back except for about 2%. I closed out my last trade, which was underwater, in frustration, refusing to go underwater. So, because I didn't want to look my wife in the eye and admit that I was my account was less than it was 15 months ago. But that was in about a 10-week period. And I lost total confidence in chart-based trading. I lost pretty much total confidence in anyone else but myself, because this guy had done a lot of homework on him. And it wasn't all his fault, but he had misrepresented, I think, reality. And I don't think he did it intentionally. I think he hadn't studied his own strategies enough, and he had enough experience. He was able to adapt his strategies to all market conditions. Yet I certainly did not. I knew I didn't have the years that I felt it would take me to learn how to trade a chart-based strategy through all types of market conditions. So I decided to fall back on my strength, which is more of very analytical, math-oriented, and started downloading historical data from Yahoo Finance, literally open, high, low, close data into Excel spreadsheet, and started studying anything I could think of. But one of the things I had heard good things about and done some reading on were opening gaps. So I started digging into opening gaps, and I stumbled on sort of a novel idea that I hadn't read about or heard about that was pretty simple in concept, just using the open, high, low, and close of the prior day session to identify opening zones. And I noticed they all had significantly different historical probabilities. So it made money literally from day one. I didn't trust it. I goofed up quite a few trades and skipped them. But after 6 months of monitoring it and trying to trade it with some discretion, I finally realized I was an idiot, and I just needed to trust the data and trade the best setups and leave the rest alone. And the rest is history.
Yeah, sure. So I guess a lot of people would know you for your work in gap trading strategies. But what was it about gaps that got you interested in them in the first place?
I needed to trade something that I understood and that I believed had an edge to it. And I will say one of my keys to early success was that I understood my weaknesses, my personality weaknesses fairly well. My wife reminded me frequently, and many of my friends. But I knew them. I knew I tend to be, I'm a pretty passionate person. So I'm a sort of a weird bird. I'm very analytical and introverted at my core. But I do wear my emotions on my sleeves a bit too much. So I needed something that had an edge that I believed in, to sort of, that I could trade knowing that I was trading something that had some inherent edge. And the opening gap, I realized the majority of opening gaps fill on the day they are created. So I define a gap as where a market opens relative to where it closed the prior day. And about 65 to 70% of the time, in just about any market you test, those opening gaps will retrace back to the prior close the same day. So I'm like, wow, 2/3 of the time the market's going in a direction, or has a tendency to go in a direction that's well established, back to the prior day's close. And it made sense to me logically that as I read or explained, or somewhere it was explained to me and I sort of figured it out. The way I think about it these days is big money doesn't want to chase an opening gap, right? So I like to pick on Goldman Sachs. If you have a sizable gap up on legitimately good news, Goldman Sachs isn't going to buy the gap up, right? That's retail prices. They're going to pay wholesale prices. They're going to get the premium price. And the way they do that is that they try to push the market back down to the prior day's close. as does the rest of Wall Street, because they don't want to chase the market. So the overnight volume may have been very light, and the news may have been legitimate, but for whatever reason it gapped up on light volume. They're going to slam it back down to get positioned in the exact same direction so they can get the advantageous prices. So when I put those pieces together and saw the math for myself, that became the setup for me.
Right. Okay. So if we just talk about markets for a quick minute, which markets are we talking about the gaps work best in?
Gaps will work in anything. And that's literally, they work in any given market to varying degrees any given year. And it's a little bit hard to predict which markets are going to work best and which ones won't work. What I found is I stay away from gaps in momentum stocks like biotech stocks and momentum technology stocks and biotech stocks, really the two categories I sort of unilaterally stay away from, because they've got their own path, right? Their own momentum for reasons that really defy historical norms. Stocks, I don't generally trade anymore. I used to, and they work well. In fact, I've worked with some folks that have had tremendous success identifying stocks that are beating historical norms. So let's say the S&P index, for example, averages about a 68 to 70% gap fill rate historically. Any given year, you'll have some sectors, some groups of stocks that are averaging 75 to 80% gap fill rates. They're just not going anywhere. And then you'll have others that are averaging 50% gap fill rates. They're moving way too much. So, but what I found is I didn't like trying to pick individual stocks. I was constantly spending my time trying to predict which sector and which stock was likely to do the best. And I also realized that the whole idea of trading the opening gap, which I didn't clarify, because gaps have a likelihood or a tendency to revert back to the prior day's close. That's mean reversion. So that's a fading strategy. That means you buy a down gap or you sell an up gap. You're going the opposite way of the crowd at the open. Because again, that's what big money like Goldman Sachs is doing. So I found fading the gaps and the indices to work better, because it's much harder for a single piece of news, even significant economic news, but any geopolitical news, anything like that, it's much harder for legitimate news that may move the market in the overnight lower volume session to sustain that move that day. Because again, it's the big indices, I think of them as being heavy. And I'm saying big indices, the NASDAQ, the S&P, the Dow, Russell, DAX, FTSE, and so on. They're going to be more likely to revert back to the prior day's close before finding a base and continuing back in the original opening direction most of the time, or frequently.
So it sounds like you're looking at gaps in the context of other conditions. So what else would you look at surrounding that gap to determine whether it's a gap you'd like to trade?
Yeah, so I do. I look at three things primarily: market conditions. Are we in a raging bull market, raging bear market, somewhere in between, right? A modest bull market, a modest bear market. And you can define them many different ways, and it really doesn't matter how you define them, I found. I mean, there are some ways that are subtly better than others, but for the most part, the key is to categorize market conditions in my mind, and I build those into my systems and my methodologies. That's the first thing I consider. Second thing I consider are short-term price patterns. I've generally found about 3 days to be the right time frame for me. You could work with 2 days, 5 days, whatever, but I like to see what's been going on short term, meaning have we been rallying, have we been selling off, going up, then down, then up, or down, then up, then down. A lot of different ways you can do that also, but generally just trying to categorize different short-term price action. And then thirdly, I have calendar-based considerations. I sometimes call them seasonality considerations, where I'm really looking primarily on what day of the week it is, like a Monday or Fridays. They tend to be more important days in the markets in terms of impacting historical odds, just because of the nature of the way money flows in the markets. I trade futures. What I'm talking about works for stocks and ETFs comparably well. I like the leverage of futures and the tax advantages, but futures especially because they do have, in theory, unlimited risk. I always use very tight intraday stops on trading the gap. Traders that trade futures often go flat. They don't want to be long over the weekend because they want to avoid any catastrophic potential risk when the market had closed over the weekends. So that dynamic of having to close out trades on Fridays adds a more predictable tendencies on Fridays, for example, and vice versa on Mondays. They may get back in, they may not, for whatever reason after they do their analysis over a given week. So Mondays tend to be a little bit more difficult days to trade opening gaps. But those are the three categories that I look at, and probably if anything over time I get more and more spend more and more time focused on identifying and quantifying market conditions several different ways to make sure I've really sort of nailed the right environment for the right gap strategy that day.
Right, okay. So are there any telltale signs of gaps to avoid?
Yeah. In fact, this is part and parcel to the other. I guess really I didn't finish it. Talking about my three primary considerations are in the context of two things. What I mean by that, I guess really three things. Opening direction, right? Does the gap open up or down? So I'm looking at how have up gaps or down gaps done under historically similar market conditions, patterns, 3-day patterns, and seasonality. And I take it a step further, and I've evolved this over the years where I'm not only looking at gap direction up or down, but I'm looking at gap size. It varies a little bit by markets, but in general, gaps, and this has just seemed to be a sort of a magical number, or common number is a better way to say. I hate using modifiers like magic. But it's something that's been consistent for me has been and for just about any market I've ever tested, opening gap size. And the key level that I've noticed is that most markets come in around is around 40% of the 5-day average true range. Meaning if a gap is bigger or larger than 40% of the prior 5 days true range, or up or down, it is statistically far less likely to fill. And if you I've studied them in terms of gap size. The smallest gaps will have like a 90% probability of filling, right? Like a 10-cent gap in the spider is roughly a 90% gap of filling on any given day. And then you go to a 20-cent gap, becomes like an 80% probability. A 30-cent gap may be more like a 60 to 70% probability. And when you start getting to the level 40, 50, 60 cents, which most market conditions, and I say that loosely, generally equates to 40% of the 5-day average true range, the numbers will drop down to like 40%. So it's sort of a stair step that's a pretty significant level. And I've tested commodities, gold, oil, corns, just about anything you think of, and it tends to be the same phenomenon occurring. So avoid those much larger gaps for fading, and I should have given that context, for fading, meaning don't expect the mean reversion bias to be as strong. Now, with that said, there's still a 40, sometimes 50% chance of a large gap filling, but there's also 40, 50, 60% chance of it going the other way. So in those situations, I really look closely back at this. I actually have three systems around market conditions, patterns, and seasonality, and want to see how those large gaps have done in each of those scenarios historically. And the last thing I haven't mentioned, just real briefly, I started off when I was talking about how I stumbled on gaps and the different historical probabilities that made a big difference for me were opening zones. Those zones are based upon the open, high, low, and close. So where not only the gap size, but where a gap occurs in relation to its prior day's open, high, low, and close levels really can give some pretty tremendous insight.
Right. So why do you think those gap zones work? Like, why do some have a higher probability of closing than others?
Well, part of it, the zones inherently incorporate gap size to a degree, right? So if you think about it, if the prior day was a green candlestick, so it closed higher than it's open, and price opens between the high and the close of that prior up day, it's normally a smaller gap, and it's got less far to move, and it's in the direction of the prior day's pricing or price direction. So anyone that was long the prior day, if they see a gap up, they're more likely to take some profits by selling at the open. So those tend to work a little better than, say, the worst performing zone on average in most markets, one I call the blood zone, below the low of an up day. So I know that's not how you spell blood, but it works. Below the low of an up day. So if you have a green candlestick and everybody's all happy, right? The market's closed and you have a big green candlestick. And then the next day, for whatever reason, the overnight market or the non-regular trading hours market, Globex, has some bad news that caused the entire index, that entire instrument, to gap down and open below the low of that prior up day, you're going to have two phenomena happen that tend to make it a very problematic gap trade in either direction, frankly. You're going to have longs selling at the open, right? They're covering their long positions, taking profits, etc., locking in profits. And you're going to have some speculators to the short side thinking, hey, this could be the sign of a major trend in the opposite direction. So they'll be selling, and that tends to really make it difficult to fade those types of trades.
Sure. Okay. And earlier you said that there's a natural tendency about 2/3 of the time for gaps to retrace and close. What about the other 1/3 of the time, gaps that open and take off?
Yeah, those are, I call those follow the gap scenarios. So instead of fading the gap, you should follow the gap. Those scenarios, again, you can identify them tend to be larger gaps. And probably the easiest one for listeners to visualize, and one that everyone should be aware of, especially systematic traders, because this is fairly easy to backtest and validate, which I do give the caveat. Markets do change, and I've been doing this a long time, but I do encourage all the listeners to do your own validation of everything I say. I believe it to be true, but I do encourage everyone to do that. So here's a good one to remember. If the market is, say, above a 200-day moving average, any market, and it has been selling off enough of late, past 5, 10, 15, 20 days, that price action is below, say, an 8, 10, 15-day moving average, some short-term moving average, and you have a gap up. So imagine visually, you're in a bull market still, the uptrend is still contained, but you've been selling off for a number of days, and you're below that, say, 10-day moving average. If you gap up the next day, and especially if it's a sizable gap, as I defined before, at least 40%, the odds of that gap filling are much lower because you're going to have a combination of anyone that was shorting that market the prior day buying to cover, right, to lock in their profits from the shorts. And secondly, most markets have bullish historical tendencies, not all, but certainly most equity markets. You're going to have speculative buyers stepping up, thinking they're buying a market at a great price, getting positioned for a continuation of the long-term uptrend. So that is a dangerous gap to fade and a much better gap to follow.
Okay, excellent. Thanks for that, Scott. So once you're in a gap trade, how do you actually manage your risk? How do you calculate your stops?
I actually trade gaps a couple primary ways. I've evolved, and listeners I think will get value out of both, and people probably need to start with one and then evolve to the other for diversification purposes. But I have a mechanical system that I've created and traded for many, many years called Pearl, named after my beloved great-grandmother. Seriously. My first system was after Otis, my great-grandfather. A little bit corny, but they were special people to me, and I was very fortunate to know them for a long time. They lived a very long time, and I just thought the world of them. Anyhow, so I like to personify my systems so that I'm blaming them and not me, which is important, right? You should not take your trading results, home with you, down to the dinner table with your family. So sometimes I get mad at Pearl Otis, but I have mechanical systems I've created that trade the best historical scenarios for different zones. So my system is a zone-based system that looks at the same things I just told you: market conditions, pattern, seasonality, gap size. And I've identified a set of rules for each zone that have met my historical profit goals relative to my risk tolerance. And each of those zones, to answer your question, some have very short targets and have very high win rates and risk more than they stand to make. Others risk less, stand to make more because it tends to be more of a trending type of zone, depending upon the market conditions. So I have a number of different, they're technically optimized for each zone and market condition. So there's no fixed number for me. But in general, I'm looking at, when I'm fading the gap, which most of my zones do, I'm just targeting the prior day's close or some point just in front of it or some point just beyond it. In terms of stop size, my mechanical system on average tends to use around a 30% of the 5-day average true range stop. So the targets and stops, while I have technically refined them a little through an optimization process, I've been extremely careful not to obsessively optimize stops and targets because you're focused on the wrong thing. And this is one of the biggest mistakes that most new traders and new systematic traders make. They get all excited about the tools for back testing, and they optimize to, down to the 1/100th of the ATR or a percentage of price. And that's just crazy. That's curve fitting. You are fitting your system to perfectly catch as many of the winners as possible while narrowly missing as many of the losses, and you're going to have unrealistic expectations. So I instead have created my systems to focus on identifying the strongest scenarios with clear directional, clear meaning clear and consistent directional tendencies. And I just try to take a chunk of profits by capturing part of that move. So that's one way, and that's the way I started really. I created a mechanical system and I mean an automated system that I manually executed. So I did all this back testing. I guess you'd call it a mechanical system, but I didn't turn on the automation. I tried a little bit, and we're going back 10 years now. I had a few too many issues with the brokerage platform not executing the trades properly, where I lost confidence in those trades in automating the process. So I said, no problem, I'll just manually execute them. So I would set up my strategies to generate my data with enough time for me to see if there was a signal or not. And if there were, I manually executed the trade right at the open. So that's one way that I've traded. Now, since then, I've purely automated it. That's not the case anymore, but that's how I evolved. And now what I've realized is I've gotten just more experienced and more knowledgeable. All of the ideas and things that I witness in the market day to day, I can't fit into a single system. So the way I've gotten around that is to create these multiple systems that they can generate their own signal, but I only trade when those signals that they generate meet my minimum threshold. And so I need all three of them to average up to a desired win rate and profitability goal. So I currently manually execute those trades while my mechanical system or automated system trades simultaneously. I don't even pay attention to it. I just make sure it's on, and I completely ignore it because I don't want to be influenced. So I have a mechanical system trading the opening gap each day, and then I'm evaluating my three systems, which is another word for multiple systems is Ensemble, my ensemble of gap trading systems. And I manually execute those trades, but I'm in the process of automating those also so I can trade even more markets.
Okay, great. Just a couple more questions about gaps, and then maybe we'll move on to those ensemble systems that you mentioned. In your previous answer, you kind of indicated that some types of gaps you won't actually target the close, but you perhaps go further. So what research have you done into what happens after a gap has filled?
So I call those extended targets. And what I've found is often gaps will continue through the prior day's close. It just really depends on the market condition. So the easiest thing to visualize if a market's really stretched to the upside or to the downside. My favorite ones are actually to the downside. So the market's been selling off 4 or 5 days in a row, just squeezing the longs, right? Hammering market participants. And then you get a gap down after you've already put in a 5 or 10 or 20-day low. Those are the situations where I am looking not only for gap fill, but I found that if the gap fills, there's like a 90% probability of it continuing through there and even closing above the prior day's closing price. So those are the ones you want to ride and hold on to. So that's the concept of holding for extended targets. Other times, let's say it's just a nice raging bull market. You're not necessarily overbought, but you're just sort of grinding away to the upside. We've had lots of that right over the past 5, 6, 7 years. Then I tend to target gap fill or just in front of gap fill because I know that, again, back to my original analogy, the traders at Goldman, they're pushing that opening gap down only so they can buy it back at a better price. And I don't want to be playing a game of trying to get greedy, holding for some extended target when I know there's big money on the other side looking for opportunities to buy. Yeah. So I tend not to go for extended targets in those scenarios.
Okay, and what do you do if your stop and your target hasn't been reached by the end of the day?
Close it out, always. I never turn it into another trade. Now, I will say I've evolved over the years. I trade the overnight using the research of my good friend and Rob Hanna, who I believe you've interviewed before and
Yep.
who I work with. He, I use his research, and he and many of our folks that follow me have asked me, why don't you just hold on to the trade? Because odds favor a gap up tomorrow, and you're long, and it just didn't fill the gap yet. Um, because in my mind, I want to track and measure the results of the core decision. I believe that's changing your plan, your original plan, which I don't like to do because it opens the door to your emotions and subjectivity. So I like to measure each decision discreetly. So what I normally do, I'll just close out the trade, take it right there at between 4 and 4:15 Eastern time, so that when the New York Stock Exchange is closing, or between the New York Stock Exchange close and the CME close for the S&P Pits. And then often I'll turn right around and establish an overnight trade in the exact same instrument. But yeah, it cost me some commissions, maybe even cost me a few ticks, but it's just a much more disciplined approach that works for me.
Okay. Now you've been trading gaps for quite a few years now. So what have you noticed for changes in the markets over the years regarding the behavioral performance of gaps?
Um, well, there's one big one that's the elephant in the room is quantitative easing. When it kicked in 2009 by the U.S. Fed, um, dramatically reduced the probabilities for shorting up gaps and change the probabilities for buying down gaps. What I mean by that is that shorting up gaps haven't made me much money in the past 5 years. The market's just been too bullish. I do think that's going to change, by the way. Is quantitative easing. In fact, our past year has been very good actually for shorting up gaps. But in general, over the past 5, 6, 7 years, it has not been. The down gaps, it changed those too. They were not as easy to capture. I'd buy these down gaps thinking, okay, short didn't work yesterday, met my data, but this down gap's probably going to work today. And I did struggle a little bit with there was extra volatility, I think because of the extra funds in the market. And sometimes I'd get stopped out and have to either re-enter or turn it into a range trade, something I frequently do, or use a range trade to get back into the market. So I've some years in the past handful of years have had low gap fade rates, even though they were gapping down, but very high end of day probabilities for filling. So I've had to do sort of evolve a little bit. But in general, I don't make many big changes at all. There've just been subtle differences. And really the way I've evolved, now that I think about it, my systems, I've only made, Pearl has been life of Otis. I ran Otis for about 5 years and evolved Otis into Pearl. I changed some philosophical things on it, but Pearl, I've made one set of changes in 4 years, and I'll probably do to fine tune it. But what I have done, so while it's had some tough times, it's been volatile. It still continued to produce money, absolutely. On the average, the same expectation I had when I designed the system. The returns have just been more volatile. So what I've done, instead of changing the system, I've just added more markets that it trades. And that's in general been my whole past 3 years. I've been trading gaps about 12 years. The past 3 years, I've really been focusing on adding markets to trade, and that diversity has really worked out well. So that's helped smooth the equity curves, spread my money around.
Okay. If you had one tip to trading gaps, what would it be?
Systematically, I assume.
Yeah.
Because non-system traders, that's my first tip always. Stop trying to guess which ones are going to work and study them.
Yeah.
So even systematic traders, stop goofing, follow your system. But my one tip for trading gaps, use multiple systems, use comprehensive analysis. You cannot consistently and reliably predict the odds of a gap filling well enough, at least for my satisfaction, using one system. Because, well, you can, but it's inferior to doing it. Well, that's what I've done with Pearl, but my results have been way more volatile. I measure return on versus max drawdown, and my max drawdown is too big relative to the returns for my liking. So when you have that, it keeps me from scaling position size to the degree I would like. What I've been doing and evolving, so my tip is use multiple systems. You'll be more selective. You won't make as much money in absolute terms, but you should have an improved profile for those trades, meaning you'll be risking less on average. Your returns relative to your average drawdown per year should improve. And if you can do that, then you can scale your capital and maximize your returns.
Right. Okay. And what about for someone who's just getting started? Where would they start to get into gap trading?
We'll go to my business, InvestorQuant. If I can just give just a short explanation.
Sure.
InvestorQuant is a commercial for-profit enterprise. I sell research there, but real important to know, everything I've ever created, InvestorQuant was formerly Master the Gap, as you mentioned, original. And that's InvestorQuant. Everything I've ever created or published publicly has been primarily, first and foremost, for my own benefit. So it's just been my way of taking my research and organizing it, putting it on the web so that I can access and use it very easily and share it with friends is how it started. And then it's evolved. So I don't create any research that I don't believe has value to it. So I'm using my own research, or eating my own cooking, as they say. So start there. Maybe the easiest thing, I did produce a small book called understandinggaps.com. You can go there and get started learning about gaps and some historical tendencies there. But then go to InvestorQuant and you'll get a much more robust view.
Now, if we can just jump back to ensembles, which you mentioned a little bit earlier, you indicated that that's a bunch of different systems. What more can you tell us about that?
Yeah, so the whole idea, again, is to reduce risk relative to return, right? Smooth your equity curve. That's what we're trying to do. I just ran out of room. And when I say ran out of room, I kept trying to put these ideas into my system, and it kept cutting my sample size down, right? So, and I'll just give you a simple example. Let's say you create 10 types of gaps, 10 categories of gaps. And if you look at those 10 categories over the past 10 years, there's been a roughly 2,000 trading days divided by 10 categories gives you 200 trades in any one of those given categories. So what I was doing, I would say, oh my gosh, I've got another great idea. What if I add another size consideration? So instead of just using large and small gaps, which is 4 total for up and down, I make 3 large up gaps and 3 large down gaps. Well, now we have 6. I've just reduced my sample size down by another third. So now my average category has about 125 trades in it. And then what if I said I want to add a 200-day moving average or something like that? Now I've reduced all the average trades down in half. So as you start adding in just a few simple ideas, you end up with too few trades to really trust the data. So what I've done is I've taken those ideas instead and organized them around my core themes. As I mentioned before, market conditions, patterns, and seasonality are my core ones. And I have systems that only focus on those themes. And what I've been doing is actually adding a couple more market condition systems because there's so many different ways to measure markets. And I only trade when the average of those systems meets my minimum desired criteria. And it's not even my desire, but a minimum level that I found gives me enough trade frequency and gives enough results. So for me, about a 60% win rate on average. So I'm looking for trades that have a 60% historical win rate because I tend to stick with those and trust them more. That means I risk a little bit more than I stand to make. And I want to know that it's made at least 15% more in profits and losses. Now I want to be clear, that is not my target. That's not enough to account for commissions and slippage and so on. But for an average of 5 systems or 3 systems, I use 5 systems for range trades. I use 3 systems currently for gaps that'll probably be expanded. But for an average, my real world results are better than the 60% win rate minimum. I'm not talking hypothetical, I'm talking about real world for several years now, better than my minimum win rate and profitability, because that's the power of ensembles. You're getting lowly correlated systems to confirm each setup. And when that happens, you're going to have much, much better results. It's the same thing. If Ensemble's confusing to people, it's actually what the National Weather Center does here in the U.S. and all around the world for predicting weather, right? They use many, many many systems with slight changes, slight iterations to predict, and they take those averages, and that creates the best, most accurate view of what's most likely to happen.
Oh, that's really an interesting way to look at it. So essentially, you're getting a number of different concepts or behaviors and then combining them. And if it meets a certain threshold, that's good enough to take a trade.
Exactly right. And I've actually been tracking it publicly at the InvestorQuant website. We've done just with the caveat, anything can change, right? And the markets do change, and this may not hold up. But tracking gap and range trades using my ensembles with these very simple rules. I'm averaging a 65% win rate over past. This is publicly traded with one set of rules across the board. 410 trades in the past year. I just did my 1 year tally because we just had the 1 year anniversary. 410 trades, 65% were winners. I don't know the profit factor numbers, but in fact, I don't even want to talk about profits, but the profits per contract, the best I've ever created, best I've ever enjoyed. So that probably means it's even beyond my expectations, which means I'm probably due for a pullback, a drawdown, right? But it doesn't. Even a pullback, it's doing fabulously well. And I'm not saying this to say, come trade my stuff necessarily, because I know you got a bunch of system traders doing their own thing, and I'm trying to help. The concept is the whole point here. If you're struggling or you need to improve your system methodologies, consider creating a couple simple ones. These systems are not overly complicated that I'm using in my ensembles, but they're very conceptually different, which means they're very lowly correlated. They don't really trigger at the same time. There's no unifying theme in them that makes them trigger at the same time, which is why they work so well.
That's interesting. I can see a lot of applications for this ensemble concept. So I'm sure a lot of people will get value out of you explaining that. So thanks a lot, Scott. I'd just like to wrap up now with a few quick closing questions. The first one, what's the biggest lesson you've learned through trading?
Biggest lesson learned through trading. Well, that could get pretty deep, actually. I won't go too deep on it. Right, trading's a very personal venture, right? I will say this. I'll give you a couple answers. So the deep one, and keep it a little bit lighthearted too, is it forces you to be very intellectually honest, right? I don't know a single. What I mean by that, it forces you to stick with the facts. I used to trade when I first started out, and especially when I told you I had that great year, and then I went to that drawdown. I was in denial. I was completely in denial, and in my mind, even I wasn't looking. I didn't want to look at my results, or it just wasn't looking at, because I found that if I obsessed over the results, the returns didn't come. So in my mind, I felt like, okay, I'm going through a little tough stretch here, but I'm probably about break even. And in reality, I was already, and I was talking about break even from my highs. So I'd run the count up. So I thought, I'm just, having a tough time here. I'm probably going sideways. And I was already down significantly. And I'd increased my position size too, which is part of the problem. But so you got to be intellectually honest with yourself. Stick with the facts. Don't play games. You're only going to hurt yourself. So I was a little slow to react to the problem that I was creating, giving back all my profits from the prior year. But in terms of lessons learned that really in trading that may be helpful for someone else, I'd have to say losses are part of the game. Just don't try to engineer the losses out of your system. It's going to cost you way more money. So accept that trade frequency is an important metric. So you don't want to get rid of all the losses, because if you do that, you won't end up with any wins. Mm-hmm. So I trade more now. Like I said, 410 trades in the past 12 months is the most I've ever done by far. That's only a couple trades a day on average, but still, that's a lot of trades for me, and that's part of the reason I'm having such good success. I'm creating an edge. So don't over-engineer, don't over-optimize. That's probably the biggest lesson for me.
That's great advice. Thanks, Scott. What do you think is the most important ingredient to becoming a successful trader?
Realistic expectations. Sort of back to the other theme, you can absolutely double an account. I've done it quite a few times actually, um, in a year. Because I often hear people, yeah, I've got $50,000, and if I can make $50,000, I can live off of that. Can I do it? Always answer, of course you can. You absolutely can. However, you can't do it without risking probably the entire $50,000 for especially someone new. The way I think about it now, if I want to make a 40% return in a year, I have to be willing to risk 20%. So after all the years I've been doing this, working really, really hard, I'm very tenacious, and that's one of my, I think, keys to success and longevity. I still, to make a buck, I have to risk 50 cents. If I want to grow my account 50%, I have to risk 25% of my account. That's just the way the math works. There's no free lunches out there. And if you can have those realistic expectations, now you've got a chance of really making a difference in your life financially.
Yeah, that's a good way to look at it, isn't it? Do you have any favorite trading books you'd like to recommend?
Other than the short book I wrote on understanding gaps, um, yeah, I mean, one of the classics that really made a big impact for me was Market Wizards. I'm still surprised when people haven't read the Market Wizards, especially the original one by, was it Jack
Schwager.
Schwager?
Yeah.
The biggest takeaway for me, and this was so enlightening and inspiring for me, was that there's many different ways to make money in the markets. You don't have to follow anyone else's roadmap. You don't have to follow mine. You don't have to follow yours, Andrews. Anyone but your own. You can create your own path, and that was to me very exciting. That I could do my homework and follow the data. So that's what I've done, and that's I've taken ownership because of that, and that was huge for me. That's the biggest one. I'm also a big fan. They're a little bit dry to read, but Van Tharp, who's a fellow North Carolinian, actually lives 10 miles down the road from me. He had a big impact in my early days of helping me think mathematically, which is what I was inclined to do, but helped me understand the different metrics. He's got some fabulous books. Those are probably the two off the top of my head.
Okay, and final question, what's the best way for listeners to get in touch with you?
You're welcome to email me. I'm pretty good at responding to emails. My name is Scott, SCOTT, at invest, INVEST, IQUANT. Invest, iQuant is the way it looks. Investaquant.com. Just go to our website and check it out. You can also reach me through there if you can't remember that.
Okay, sure. So thanks a lot for your time today, Scott. Is there anything else that you'd like to mention before we wrap up today?
Yeah, to all you traders out there, avoid risk of ruin, right? Don't blow up your accounts. So have realistic expectations. Take it easy, meaning trade slowly until you really learn what you don't know, because you don't know what you don't know right now, and that's what's going to kill you. And if you take a long-term view on it, trading can be pretty phenomenal part-time or full-time. So I wish everyone luck. If we can help, I can help. Let me know. I've enjoyed it, Andrew. Thank you.
Thanks a lot, Scott. So if anyone wants to learn more about Scott's work, check out his website, investiquant.com. I'll have a link to that in the show notes. If you go there, you can find quantitative research tools and services for active investors and traders. So thanks again, Scott, for your time today, and all the best.
Thank you.
How did you like the chat with Scott this week? Here are two of my favourite insights. Firstly, there are many different ways to trade gaps successfully, from the size of the gap to the location, which Scott calls gap zones. You also need to take into account market conditions, recent price action, seasonality, volatility, stops and targets, plus many other factors. So there really is a lot to it. If you're going to trade gaps, you better study up on them or follow someone who already has. Also, if you trade a system that enters on the open, you may want to consider the effect of opening gaps on your entries. I also found the idea of ensemble systems really interesting. It's not a new idea, it's used in weather prediction, but the applications to trading could be very interesting. I think we might need to hear more about that in the future. If you want to get more information about this episode, head over to the show notes, bettersystemtrader.com/18. We have links to additional content if you'd like to know more about Scott's work. We have some great guests coming up in the coming weeks too, including a father and son team, a prop trading firm, and one of the biggest names in trading over the last 50 years, so look out for those. Anyway, that's it for this session. I hope you enjoyed the chat with Scott Andrews, the Gap guy, as much as I did. Thanks for listening to Better System Trader, and I'll catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.